Hi, everyone. Hopefully we won't have any issues with me recording today. I'm actually not using my headset. I'm just going right with the computer mic. So like I said, I hope it goes smoothly, but we're starting chapter 6. Now, chapter 5, we looked at how to value bonds. Now we're going to that other financing option, stocks. So the key concepts and skills will be, we're going to comprehend that stock prices depend on future dividends and how they grow. So we're going to compute stock prices using a few different dividend growth models. We're going to understand when we're done how growth opportunities affect stock values. We are going to appreciate the price earnings ratio. And that's a rough one to wrap your head around. And then we're going to take a look at the stock markets and how they work and different types of stocks. So we'll get the computation and calculation stuff complete in the beginning of the chapter, and we'll move on to the more theory-based stuff at the end. So that's just a little outline of how we'll proceed. So let's get to it. Now, so you know, and we do this a lot in accounting, when we need to value what an asset is worth today, we take the present value, so that those calculations we've been doing, of all of its expected future cash flows. That's what we did with the bonds, right? We said, what's the value that the company or the person who owns the bond that they'll receive in the future? Either we looked at interest present value and the face value present value and said all of that added together, given a certain discount rate or yield to maturity, is the price that it should sell for. We do the same exact thing with stocks and really any asset. Stock ownership does produce two cash flows, and the one is dividends, which is the payment to the shareholders from the corporation, and usually they're paying the profits of the corporation, and then capital gains, and that is the amount of money the stockholder will receive above what they originally paid for it. When we value stock, we really look at the future dividends, and we use those to determine the value of the stock. So we have some formulas on page 165, and we're going to be using these. But there's a couple different scenarios we could look at. What if the stock is going to pay a dividend and it's never going to grow? It's going to be the same dividend year in and year out and year in and year out. So that's called zero growth. There may be a dividend that it's going to constantly grow at the same rate, 5% from year to year to year to year. So that's another model we'll look at. How do we calculate the selling price or that market value of the stock today, times zero? And then there's that differential growth model. So maybe it'll grow a little bit, like 4% for 3 years and then 6% for perpetuity. Okay, so different models. There could be other ones out there also, but these are the ones we're going to look at. So you could wrap your head around, how the heck do they come up with this stock price? So here's our first model, the zero growth. As I said, you're assuming the dividends will remain the same amount. It's going to be $2 from year to year to year to year, forever. Well, we could use the formula to value those: price of the stock, price at time zero today, present value, equals, now this is important, not the dividend this year, but the dividend next year. So even though we're valuing the stock as of today, we ignore any dividend from this year, and we determine what will be the dividend next year. Well, that's going to be constant, so it's going to be the same amount. But where this is really going to be important for our calculations is when we start growing our dividend. So it'll be the dividend divided by 1 plus your discount rate to the first power. That will give you your present value of next year's dividend. Just that. And then we would do this next computation by using the dividend from the second year divided by 1 plus our discount rate, or our return, to the second power. And you would keep doing that in perpetuity. So we could refine that calculation, and really it's determining the present value of a perpetuity with no growth. So you would take, and we did these in 2 chapters ago, you would take your payment amount each year, which would be the dividend, and divide it by that return or discount rate, whatever you would like to call that. So you need to know that. So suppose Big Deal Company will pay an annual dividend of $2 per share on their common stock that will never increase or decrease. The market rate of return is 8.5%. What is the maximum amount you should be willing to pay for a common share of Big Deal Corporation? Well, in this model, we just take the dividend next year, which is still going to be $2, and divide it by the 8.5% market rate of return, or required rate of return, however you want to look at it. What kind of return do I want to get as the stockholder? 8.5%, what everybody else in the market is getting. So when you do that, the most you should pay for this stock is $23.53. So that's one model of determining stock price. Here's our next one. There's a constant growth on the dividend. So now the dividend will grow at a constant rate each year, which we represent as G. So the first thing you have to do is determine what will be that dividend next year, because that's what I'm going to use to start calculating my price of my dividend. So we take the dividend times 1 plus the growth rate. So the dividend in year 0 times 1 plus the growth rate. Now they're showing you how the formula is created. You just need to know the formula, right? So since future cash flows grow at a constant rate forever, guess what this is? It's a perpetuity with a constant growth, something we saw back in chapter 4. So this is important. Don't take the dividend in time 0, year 0. The dividend next year divided by that market rate of return minus your growth. Just like you did with the perpetuity that is constantly growing at the same rate. That will give you your price of the stock at time 0. So now it's important we use that proper dividend amount. Let's take a look. Suppose Big D just paid a dividend of 50 cents. So there's your dividend at time 0. It is expected to increase its dividends by 2% per year forever. If the market requires a return of 15% on assets of this risk level, so there's your rate of return, how much should the stock be selling for? Take this year's dividend at time 0, grow it by 2%. That'll be your dividend year 1. Then divide that by your market rate of return minus the growth rate. And you'll get $3.92. So this is really important. If they give you the dividend just now, times 0, you need to grow that and determine the proper amount dividend at year 1. So that's constant growth. Pretty straightforward. Not too bad. We're used to these, I hope, right? Now, and this is what I was just saying. It's critical to understand that in the constant growth model, whether it, well, not whether anything, it's just in this type of model we just did, calculations are always based on the next dividend. So if the situation only provides information on the last dividend, you have to increase it like we just did to arrive at the next dividend. If it provides you the value of the next dividend, then you just use that in your calculation. But please be careful of that. And analysts must discriminate whether they have information about the next or last and then proceed. So be very, very careful, especially in your practice and graded assignments. Okay, so, just like Emerald, we got to keep spicing it up and kicking it up a notch, right? So we did no growth, constant growth, now differing growth. So it's a little bit more complex of a calculation, but it's doable. Assume that dividends will grow at different rates in the foreseeable future and then grow at a constant rate thereafter. So sometimes we have that. A corporation may, we make some assumptions like that dividend will grow 3% for 6 years, and then it'll grow 7% for 4 years, and then it'll grow 10% for forever. So we estimate future dividends in the foreseeable future. That's the differential growth stock model. We estimate the future stock price when the stock becomes a constant growth stock. Then we compute the total present value of those first two. Okay, so those are the steps we're going to take. Let's take a look. It's easier to look at an example, right? So this is just a picture of the scenario. This graph demonstrates the dividend profile for a company with differential growth. So it has a 15% growth rate between 4 and 6, it looks like. Okay, let's see. Maybe more than that, 1.15 times 1.15. Yeah, so over this part of the graph, 15% growth, and then, then in this part of the graph, 10%. Okay, so we have to, here's what it'll look like graphically, but we've got to focus on the growth rate. That's the little g. 15% growth rate, 10% growth rate. Now, assume, first of all, that dividends will grow at rate G1. So the first growth rate for n years. And then grow at rate G2, a different growth rate, perpetuity. So they're just showing you how they derived the formula. So it's not a huge deal if you don't follow it. Just know the final one. So first of all, you want to calculate the dividend in year 1. So take the last dividend times 1 plus the first growth rate, because that's how much it'll actually grow. And then we will calculate each dividend amount based on that. And it gets to the point where our dividends for n could be represented as n, and then take the dividend at n minus 1 times 1 plus the growth rate, and we convert it all over, and then we get to, okay, keeps going and going and going to here, okay? So here's how we determine the value, this growing annuity, and that's basically what it is at a rate of G1, growth rate 1. So that could be looked at as that, I think the first one was 15%. So here's our dividend at year 1, C, that's what that represents. Divide that by your market rate of return minus your first growth rate. Multiply that result by 1 minus 1 plus your first growth rate to the number of periods that growth rate will be in effect. that first growth rate. And then divide that by 1 plus your market rate of return to that same period of time for that first growth rate. So that's our first calculation. We then add to that the present value or discounted value of a perpetuity growing at rate G2, which is our second growth rate, that starts in the first year after our first growth rate stops. So that calculation, or that part of the price, so this is considered price A up top. The second bullet is considered price B. We add price A and B together to get the total stock price. We're going to take the dividend at annuity, where the last growth rate 1 stopped, and determine the next dividend, divided by your market rate of return minus the growth rate 2. That's going to go into perpetuity. Divide that by 1 plus the required rate of return to the T power, and that was your first growth rate time period. That's always that time period. So I could tell you the formula, but let's see it in action. There it is all together. So there's our first formula, PA, and then the second formula. A common stock just paid a dividend of $2. The dividend is expected to grow at 8% for 3 years and then grow at 4% forever. What is the stock worth? The discount or market rate of return is 12%. Be careful. The first formula, the C, is the last dividend times 1 plus the first growth rate, which is 8%. Let me go back. Yes. Okay. Then divide that by the discount or market rate minus the growth rate. And that result will give you $54. Multiply that result by 1 minus 1 plus the first growth rate of 8% to the number of years, the T, that growth rate will be in effect, 3. Divide that by 1 plus your discount or market rate of return to the same number of periods. That will result in 1 minus 0.8966. Multiply that result by $54. So the first part of the price, so the first growth rate, that part of the price results in a present value of $5.58. That's what we just valued there. So the dividends are growing 8% for 3 years. What's the present value of those first 3 years worth of dividends? Now we're going to calculate the present value of the remaining dividends that will grow at 4% for perpetuity. So 2 distinct calculations in 1 big formula. What we do is we say, okay, the dividend today is 2. What will it be in 3 years? Well, it grows at 8% each year, right? So times 0 times, and you could just go times 1.08 times 1.08 times 1.08, but that will give you the last dividend at an 8% growth. Now add and determine the next year's dividend by multiplying that by 1.04. Or you could take 1.08 to the 3rd power times $2. So when this thing is done growing at 8%, it will be at $2.52 basically. But that's not the value we use for this second calculation, because we need to know what will it be when it grows 4% that first year. And that's $2.62. You're not done yet. Divide that by your rate of return, the discount rate, minus that new growth rate, the second growth rate. Now you get, oh, that's not right. I divided that wrong. Let me see. Retro, hold on, let me, no, wait, times 1.08 times 1.08 times 1.04. There we go. Divide that by 0.08. $32.75. I just put something in my calculator incorrectly. So that's the value in our numerator in that second formula, which is helping us determine the present value of the dividend now growing at 4% in perpetuity. So the first calculation, what's the present value of the dividend growing at 8% for 3 distinct periods? All right, now divide that by 1.12 to the third power, which is 1 plus your discount rate, to the same number of powers. So remember, that's over here, the same number of periods your first percentage, your first growth rate grew at, and that was 3. Once you do that, you'll get $23.31. So the present value of the first growth at 8% for 3 periods, $5.58. The present value of the second growth in perpetuity of 4% is $23.31. Add them together, price of the stock is $28.89. So a lot of stuff there, but that's because the stock is growing at 2 distinct rates and one goes off into perpetuity. Just looking really quick in your book. I think we're in good shape there. If there's any kind of questions on that, please make sure you let me know. I think that's probably as extravagant as our dividend growth models will get. So constant growth rate at a no growth rate, or differing growth rates. All trying to determine what the price of the stock should be. Okay. Now, sorry, my dog's drinking some water. They're just showing you here what we're actually calculating. So if you can't picture it in your mind, here it is. Here's our timeline for our first 3 payments. So the end of 1, 2, and 3, we're discounting that back to get our first amount. Then we need to determine what our next dividend will be, and then determining that present value in perpetuity. Okay, and that's how it all jives out. Okay, so those are our models. Now, where do we get these numbers from, right? Where are these parameters coming from? And a lot of times they're estimates. Now, the first one, the growth rate model. The value of a firm depends on its growth rate and its discount rate. So where did these come from? Well, the growth rate comes from the retention ratio, retention being how much of the earnings the company keeps, what percentage does it keep. Dividend payout ratio is the other ratio, remember? So net income is the amount of money the company makes. 30% maybe goes to, well, in our example we're about to look at, part of it goes to pay dividends. Well, the other part stays in the company. So the amount that stays in the company divided by the net income gives us our retention ratio. The return on retained earnings, okay, is basically our return on equity. Okay, so if we know our return on equity, we know our return on retained earnings. So suppose a company has a retention ratio of 70% and earns a return on equity, which we talked about back in chapter 3, what is the growth rate? Well, simply take that retention ratio of 70% times the 12% return on equity, and your growth rate, your G, is 8.4. So you're not like grabbing numbers out of the sky. You can actually calculate that. So when you're determining your growth rate, you got to think about those assumptions. How much is that company going to keep in the future? And what's their normal return on equity? That will determine the dividend growth rate, the G. Where does this R come from? That discount rate, or that we also call it the market rate of return. The discount rate is actually two parts. The dividend yield. Remember, the dividend yield is what percentage the stockholder is receiving in dividends. Okay, divided by the price of the stock. The growth rate in dividends is the capital gains yield. Okay, so down at the bottom of page 170. The rate at which the value of the investment grows. So there's some estimating maybe in here, but in practice, there is a great deal of estimation error involved in selecting an R. So it is an estimating process, but we're showing you where it originates from. Sometimes there's cases that there's a lot of skepticism in figuring out a rate of return because maybe there's stocks that aren't paying dividends or stocks with growth expected to equal or exceed their rate of return, that growth, the rate of return. So if the stock's growth rate is expected, the growth rate in dividends is expected to equal or exceed the rate of return, that's weird. Because remember, in our calculations, you're like rate of return minus growth rate. Well, if growth rate's larger than your rate of return, you have some issues there. Because now you have like a negative number in your denominator. And a negative price to determine stock value. So you want to be careful of that. And they talk about that a little bit in your book, just so you're aware of it. Now, here's how we can use our dividend growth model to determine the discount rate or market rate of return. Remember, the price of the stock at time zero is the dividend that was just paid times 1 plus the growth rate divided by that discount or market rate of return minus growth. So then again, D1, dividend, the next dividend divided by the required rate of return minus growth, or discount rate minus growth. We can rearrange this, do some algebra, and what do we come up with? R equals the dividend at the end of year one, or I should say the next dividend. Whoops, sorry. Oh, sorry about that. I was going so well there. The dividend, the next one, divided by the price today plus the growth. So it's just about putting the variables into the formula that we do know. So D1 over price is our dividend yield, and growth is the capital gains yield. That's what we, that's the growth expected on the stock. Imagine that Solar Corp's last dividend was 65 cents per share. Solar dividends are growing at a rate of 4%, and the current price per share is $11.25. What is the market R, or that market rate of return discount rate, implicit in Solar's price? Because remember, that helps create the price. We'll take the dividend for next year. So 65 cents times 1.04, 1 plus the growth rate. Divide that by the current price of $11.25. You'll get 0.06. Add that to the growth rate of 4%. So right now we're saying the dividend yield is 6%. So dividends are being paid out at 6% of the price of the stock, and the actual growth rate that will occur because the company's retaining their retained earnings and their return on equity is growing at a certain rate will be 4%, the capital gains yield. So together, that discount rate is 10%. So that's how it could be calculated. Also be aware, dividends may not be a firm's only cash payout. Now this gets really a little bit crazier and trickier, but recently many firms repurchase shares of stock from their stockholders. So essentially, the corporation is going to its stockholders and saying, we want to buy your common stock back. So now the shareholders are receiving payments from the corporation that aren't dividends. Okay, so it's just saying it's another form of payout. You could use the dividend growth model, okay, to value the price of the shares when this is occurring. But you need to keep in mind the price of a share will be higher if considering total payout rather than just dividend payouts. So you can read through that. There's no calculations here or anything. We're just letting you know about that. Of course, after I say there's no payout calculation, right? I didn't think we had one. So we don't go into it too much here. Well, I better talk about it then. We said it's like the dividend growth model anyway. So you're going to use that same formula to determine the value of a stock when there's when there's a payout besides dividends. A firm's forecasts income of $4 per share and will pay out 30% as dividends, 30% as a share repurchase, and will retain the rest. So they get $4, that's their forecast of income. So their earnings per share is $4. They're going to take 30% out and pay it right out. So $1.20 pays out as a dividend. They're going to take another $1.20 and repurchase shares. So there's another $1.20 going to the stockholder, and will retain the rest. So the other 40% or $1.60, they're going to keep in the company. What is the price of a share? Take your dividend growth model. Take the $4 times 30%, which will give you your dividend payout, divided by 10% minus the growth rate. So $24 if you use the dividend growth rate. I didn't see the total payout model in here, but they talk about it. So the total payout model says, no, now take all the payout. So you're usually using basically the dividend growth model, but instead of just accounting for the money being paid as dividends, account for all the payout that the shareholder is going to receive. So they're really going to receive 60% of the $4, 30% in dividends, and then 30% for share repurchase. So $240. Well, if we look at total payout and take our discount rate minus our growth, this is saying that the price should be $48. Okay, so it will be higher if you use total payout instead of dividend growth model. And the dividend growth model is the one you want to use. So that just ran us through an example there. Sorry about that. All right. I wanted to get to price earnings ratio because we are really going to appreciate it, right? Comparables are used to value companies based primarily on multiples. Common multiples include the price to earnings ratio and the enterprise value ratios. Let's see what these are about. Price earnings ratio is an important ratio, and you talked about it back in chapter 3. It's calculated as the ratio of the price of the stock divided by the earnings per share. Now, we talked about earnings per share back in 2 or 3. Earnings per share is how much net income the company makes for each share of common stock. So how much earnings are attributed to each share of common stock? So that's the maximum amount from this year one share of stock could receive as a dividend. If we divide that into the price per share, it gives us the price earnings ratio. Here's how I wrap my head around this, and hopefully you'll understand it in this if you're having trouble with it. It's the value the market places on $1 of earnings per share. The value the market places on $1 of earnings per share. So write this down. A company always comes out and predicts their earnings per share. So let's say this company, Company A, came out and said, our earnings per share is going to be $2 when their price earning ratio is 16. So predict earnings per share to be $2 when their price earning ratio is 16. Their actual earnings per share come out. They're $1. They're $1 less than the $2 they predicted. Theoretically, based on the PE ratio, the price of the share of stock should decrease by $16 because the market values $1 of earnings per share at $16. And that's how you can view price earnings ratio. Now, how can we price with this comparable? Suppose your company has earnings per share of $1.69. The industry average price earnings ratio is 26.94. What is the estimated price for your company stock? Well, you can take your earnings per share and multiply it by what the industry or the potential investment that you want to look at, what the earnings per share is for that company, times the average price earnings ratio, because that's how much the market values $1 of earnings per share. So if earnings per share is $1.69, we'll multiply that by the 26.94 PE ratio. The stock price should be $45.53. So it's just another way to value the stock using price earnings ratio and earnings per share. Sorry about that. I decided to eliminate that slide. Okay, let's get back. Next one is the enterprise value ratios. Now, the price earnings ratio focuses on equity. What if we want the value of the entire firm? So that'll tell us the price of the stock, the PE ratio, that helps us determine that. But what's the value of the entire company? Well, enterprise value will be the market value of all the equity plus the market value of all the debt minus cash. So like the price earnings, we compare the value to a measure of earnings from a company level. This is earnings before interest and taxes. Let me make sure that's what they use here. Interest, taxes, depreciation, and amortization. Oh, there it is, before earnings, interest, tax. So EBITDA, yes, we actually have a pronunciation for that in accounting, presents, or EBITDA represents a measure of total firm cash flow. So that's telling us how much of our earnings is really cash. It's our earnings before deducting interest, deducting taxes, deducting depreciation and amortization. We divide that result into market value of equity plus market value of debt minus cash. And that gives us our enterprise value. Now, it's just talked about in your book a little bit, and they run through an example. There isn't one here, don't believe, on the PowerPoint. But if you take a look on page 175, you could see this thing in action. So there's a company, Illinois Food, has equity worth 800 million, debt worth 300 million, and cash of 100 million. So the numerator, the enterprise value here is 1 billion. Then we see their income statement. So their earnings before interest, taxes, depreciation, and amortization would be the 60 plus 16 plus 24 plus 100, or 200. So 1 billion divided by 200 million would give us an enterprise value ratio of 5. But that is an overall. Now, imagine the average ratio in the industry is 6. If QRT, which is another corporation in the firm, has that earnings before interest, taxes, depreciation of 50 million, and it's similar to the rest of the industry, its total value can then be estimated at 6 times $50. So we're looking at a different company there. But now we could determine what is its value overall. Price earnings ratio, just stock, equity, enterprise, the whole enchilada. Now, in chapter 7 and 8, we're going to talk more about the value of a project. Okay. But how do we value stock using what we call free cash flow? Sorry, they don't give us a lot of stuff to work with sometimes on the PowerPoints. Take a look on page 177, and this is a great example to go through. And we're going to be using these more in chapters 7 and 8 to value projects. So you could think of free cash flow is as the cash flow that will be realized over the years. So there's the first 5 years at the top of the page of cash flow for a company. So what is the value of its stock? Well, we could take each number there and discount or determine the present value of each one individually. And that's what in the middle of the page they're doing. Okay, so we could take then the 108 divided by 1.16, that will give us the present value of the first year today. Then we could determine the present value of the second year's cash flow, but now we divide it by, and by the way, the 16% is the discount rate. So 1.16 to the second power, because that's the value, that 118.80 is the cash flow at the end of year 2. We want to know its value at the end of year 1. And then we do the same thing with year 3's amount. So we calculate the present value for each one of those individually based on the dollar amount of the net cash flow and at what time period it's occurring, add them all up, and there's your value of your firm, 415.63 million. Okay, so I just wanted to show you that that's also a way of valuing stock, or that overall value of the firm. So different ways. We looked at using dividends, using the PE ratio, looking at the value of all firm, the whole firm, that enterprise value ratio, using that ratio to determine the value of other firms, okay, and free cash flow. So now we get to the non-calculating part of our discussion, which is the different features of stock. Those of you who never had finance or an accounting course, there are two distinct types of stocks. The first is common stock, and that's your more common, not to make a pun, but most common stock have voting rights. And that means that they can actually vote for the board of directors for the corporation. Now, there's different ways of voting, and they talk about them on the bottom of page 178. And it has to do with allowing minority, and books have stopped using that. They call them the non-controlling shareholders have a say in the votes. Because if somebody owns, or a few people own more than 50% of the stock of the company, they are the majority shareholder, they run the company. So their vote, if I own 51 shares and there's 100 shares sold, it doesn't matter what the other 49 shares or votes say, I win, okay? So to overcome that and let those non-controlling people, those other 49 votes, have some type of say, some voting is cumulative versus straight. So the effect of cumulative voting is to permit non-controlling participants to have a say. So what they do is, under cumulative voting, is they take the number of votes that each shareholder may cast. So it's usually the number of shares you own, and multiply it by the number of directors to be elected. And then the directors are all elected all at once. Okay, so you can go back and read through the example. But this allows for people who are non-controlling owners to have some type of say in who becomes a board of directors, because that's who the common shareholders get to vote for. Straight voting is, here's the number of votes, cast your votes. Okay, so it just depends on what the corporation decides to do, what's fair. Proxy voting is when one shareholder gives another, they give their right to vote to someone else, and that's allowed. There's different classes of common stock. There could be A, B, C, and it all depends on the company. Different classes of stock may have different dividends attached to them, different rights, things like that. There are other rights with an owner of a share of stock. They share proportionally in declared dividends, meaning when the corporation is going to pay a dividend, common shareholders have a right to share in those according to their ownership percentage. They have a share in any remaining assets when the corporation liquidates, meaning the corporation isn't filing bankruptcy. They just sold all their assets, paid off all their liabilities. The money left over will be divided among the stockholders. And then finally, the preemptive right. These stockholders have the right to retain their ownership percentage when new stock is issued. So I don't have it up here, but if you want to write these numbers down, you own currently 100 shares of a company's stock when they have 200 sold. So you are a 50% shareholder. You own 100 of the 200 that have been sold. The company wants to sell more stock. They want to sell another 100 shares. So that afterwards, there will now be 300 shares outstanding, or 300 shares sold. Well, if the company ignores you and just sells the stock, you still only own 100. So now your ownership percentage went from 50% down to 33%. The preemptive right says, no, the corporation should come to you first and say, do you want to buy 50% of these new shares of stock so that you maintain your ownership percentage? You don't have to, but that's a right you have as a common stockholder. Another type of stock is called dividends, or preferred stock. I'm looking at the word dividend. Preferred stock. And stock is stock, it's ownership, but they have different rights and characteristics. When you are a preferred shareholder, you normally do not get to vote. However, you know your dividend amount right up front before, it's right on your stock certificate. You will receive your dividends first before common shareholders receive theirs. Okay, there's no guarantee you will get a dividend every year because the board of directors is not required to declare one, and that's who decides if a dividend is paid. So in a year, a dividend isn't paid to the preferred shareholders. They usually have this characteristic of what's called cumulative. So let's say you own preferred stock and every year you should receive $4 dividend, but you don't in the 1 year because the corporation decided not to declare a dividend. Well, if your stock is cumulative and they declare a dividend this year, you will get last year's that you missed and then this year's before common stockholders even get any of their dividend. So common stockholders, we say, usually get the leftovers because preferred stockholders have a preference to dividends. They get theirs first. And that's the major difference along with those voting rights. But preferred stock generally have those same other characteristics as well. Now, in our final couple slides, we're going to talk about the stock markets. So there's what we call dealers and brokers. Dealers buy stock, maintain it as inventory, and sell it. So they're buying and selling stock and they're owning it. So it's like they're selling their own stock. Brokers bring the buyers and the sellers together and don't get involved in the actual transaction. So those are your two major kinds. Again, there's ask price, bid prices, and the spread, just like with bonds. The New York Stock Exchange has almost 1,400 exchange members, different corporations on it. It's the largest stock market in the world. Of course, it's in New York City on Wall Street. And you have to be a license holder. So you can't just say, oh, I have a corporation, I'm going to go trade myself on the New York Stock Exchange. No, you have to actually acquire a license and go through some hoops and application process and all that so that you know that. Now, or I'm sorry, I'm confusing that. Let me back up. The license holders are the ones who can actually trade the stock on the stock exchange. What I'm talking about are the corporations. They still need to be vetted and decided if they can be traded on the stock exchange. So the license holders or the members are the ones who can trade the stock on the stock exchange. They're entitled to buy or sell on the exchange floor. Now, there's designated market makers, floor brokers, and supplemental liquidity providers, and they all have a distinct job. The designated market makers, they're known as the specialists. They act as dealers for a particular stock. So usually each stock has its own designated market maker. So what are they doing? They're buying and selling the stock. They're updating bid and ask prices. Floor brokers execute trades for customers, and they're trying to get the best price possible, whether it's they're selling or buying for the specific customer. And then the SLPs are investment firms that agree to be active participants in stocks that are assigned to them. And what their job is to regularly make a one-sided market trade to regulate the price, to keep the price at a certain level. So they're actually hired by the corporation to make sure their stock price doesn't go really low or really high, whatever the corporation wants. Okay, the operations are physically in New York, so it's an actual market, but it is computerized a lot. So they talk about the floor activity in your book. You can read through that. There's some great YouTube videos. I'll post one out on our website. There's an actual DMM that walks you through the market, and you can learn more about that. So that's our New York Stock Exchange. Another stock exchange is the NASDAQ, which stands for National Association of Securities Dealers Automated Quotation System, and that's what it is. It does not have a physical marketplace. It's all computerized. So websites allow investors to trade directly with one another, and this helps increase stock liquidity, so it's quickly being traded, and competition. And there's a large portion of technology stocks on this market. So you could read more about them. So here's our stock market reporting, our quote. Take a look, the previous closing date, so that's what the stock closed at. That's what it opened at. Here's our bid and ask. Okay, the days range where the stock went during the day, 52 weeks out, lowest and, where it went from 52 weeks ago to what lowest and highest, I believe that is, the volume of stock that has traded, the average volume that trades. Okay, and then there's some other items in here. There's earnings per share, price earnings ratio. We'll be talking about beta and market cap in coming chapters. Forward dividend and yield. See, all these things that we need in finance to help us do our calculations. Tells us it's currently trading at 208.64. It was up $2.40 or 1.16%. So take a good look at that, and you'll learn, you can see there that what those different numbers mean. And this one is off, this is Costco, it looks like. And that's the one that's there. I think it's off the NASDAQ. But this is a common way you'll see information quoted. So the rest of this is just a little quiz. So take a look at the video that I'll put out there. A lot of this is just reading, like I said. I wanted to get through those calculations for determining stock price, though, using dividends, whether it's a no growth, constant growth, or differential growth, looking at PE ratio, looking at the enterprise value ratio, looking at free cash flow, all of that to help us determine not only maybe stock price, but also the entire company's value, and then get a good read through and ask any questions about the different types of stocks and the stock market. Okay, so that ends our discussion of chapter 6.